enjoy this content, if you like it, please think to tap the like button below, subscribe, and share this video with people that you would think would be interested. With that out the way, let's get to it. So this one is, what's the difference between a TSP and a 401k and a Roth? Now, mind you, I know nothing about a TSP, never heard of it before, and I almost want to toss in there one more, a SELP.
Okay.
You know, and then when and why should you transfer to a Roth, if you should even do that?
Okay. So let's start off. TSP, Thrift Savings Plan for a governmental employee. Mm-hmm. And they invest in there through their job at the governmental agencies, and they take monies out pre-tax, and that's how they gain their monies through their retirement. 401k for a private private company that has employees, and they go into and they put monies in for their retirement. Then you have a Roth IRA. A Roth IRA can also be, they've now put Roth IRAs are part of the cafeteria plan for private organizations that's at your jobs that you may work as a W-2. But Roth IRAs are when you pay taxes, or you invest after-tax money into a retirement vehicle so that you don't have to pay taxes later on.
Yeah.
A 401k or TSP is you're pre-tax. You avoid the taxes, but you pay taxes later on down the line.
Right.
A lot of times, persons go into a Roth IRA and they go into those monies so that they can now say, hey, this is after-tax monies, and I'm only going to pay taxes on the gains later on. And I strongly suggest everyone go into a Roth IRA and have a mix of both. You want to avoid taxes now, but you also want to have some monies for later on. The age-old saying in accounting is, when you're young, you want to avoid taxes. When you get older, you want to pay taxes. Why? Because when you get older, you want to pay taxes because your income is fixed and it's less. Mm-hmm. So you want to pay taxes as you get older when you're over 65 or in retirement, because that money's there. Roth IRAs are another source of income that you don't have to pay taxes on the gain. So if you start a Roth IRA right now and you put in after-tax monies up to $100,000 or $50,000, when you retire and you start to take monies, or after the period of time that allows you to start taking monies out, then you only pay taxes on the gain. Now, sometimes people take monies out before their retirement. There's a penalty for doing that, mm-hmm. because it's meant for retirement.
Right.
A SEP is for when you have that for individual that has a business and they want to put in a self-employed pension plan, and they want to go ahead and put that, and it's allowable to be deductions for you to put in there as a business owner to also have your own retirement vehicle going for you as an individual for your business. And it's deductible on your personal side. It's based off a percentage. It's based on how much are you able to have as a net income. You can put up to $40,000. I always caution everyone to be careful of the SEP, that you put that monies in there, that you can take the $40,000 deduction up to that amount, but it does not equate to a dollar for dollar deduction. So you may put $40,000 in, mm-hmm. but you may only receive a benefit of $12,000 in tax deduction. Mm-hmm. So be careful of that, because do you have that much discretionary income to give away? Sure. $40,000 and then only receive a $12,000 deduction? Sure.
So one other follow-up with this one is there, I mean, I'm sure the ideal time to start a Roth or any of this stuff is, I would say, when you turn 20.
Absolutely.
2021. But is and this seems like a redundant question. I feel like I know the answer, but is there too late?
No. I never say it's never too late. And the reason why I say there's never too late, when you get other deductions starting to help you out, you get a catch-up reduction at 50 years old, and then you start at 55. But I will say up to around 50, 55 before you start going into retirement. And as long as your income levels allow it, you definitely want to have a variety and a mix of monies to go towards your retirement. I'll give you a tidbit. What we say, you want to have your before tax monies through your 401k, your TSP, your Roth IRA. You want to have your cash value that we talked about earlier through your life insurance available for you. You also want to have your money market securities through your investment, through your savings accounts, your money market, and also your investments that have your mutual funds and your stocks. If you have all of those, you've done the best you could right there, as along with having your investment properties, your properties. You gain your wealth, you have your wealth at